Okay. Good afternoon, everyone. Thank you for being here. Call this meeting to order at 3:02. First order of business is election of chairperson, vice chairperson, and secretary. Which I'm currently the chair. Mark is the vice chair and Carol's the secretary. Any nominations? Accept any nominations? Any motions? Have a motion. Peter Hursley, for a second. All in favor, say aye. Aye. Approved. Yep. I don't have any board communications. Is there anything that's already on the agenda? Yeah, finance director's report.
Okay, so for the quarter ending 7/23, the revenues are up from last quarter by $12 million. Mainly at the budgeted employer contribution for that side were posted during, and that equates to about $5.2 million. Also, the increase was dividend income and a positive realized gain of so it was good work. Expenditures have increased by approximately 5.8. Majority of this is monthly for a total. And as well as the majority of the administrative costs typically program. That's the IPs, the Sage View, and auditors. Our contributions was up slightly from last quarter by about $100,000. There were a handful of employees that had left, but because they're employees, so all in all, very
Thank you. Moving on, hopefully everyone's had a chance to read the November 9th, 2023 meeting minutes. Entertain a motion. We have a motion by Mark Opinger, second by John Burbank, and any discussion? Not all in favor, say aye. Authorization of payments. There's not any. There's just we should take one motion.
I move be authorized.
Second. Motion from Carol Pratt, the second is Pollard. What was the what was static? Aye.
A little bit closer. Okay, great. Okay, so we'll get right started into this. Let's move ahead to page 5 of the presentation. And so I'll just get you up to speed what's happened over the quarter. We actually, third quarter, we had really strong GDP growth. It was around 5.8%. Phenomenal. Third quarter, our fourth quarter estimates are around 3.3%. So really strong. I mean, most economists were expecting fourth quarter to slow down a lot, somewhere around 2.25%, 2.5%, and we exceeded that. Again, they're estimates, so it could change, but still pretty powerful. Interesting fact, and I may have talked about this last meeting, but for the third quarter, Beyonce, Taylor Swift, Oppenheimer, and Barbie, those four things alone contributed $8 billion to the GDP growth, which represented 0.6% of that 5.8%. So we knew the fourth quarter, we knew that going into the fourth quarter, the concert season was over, right? So we knew things would slow down a little bit, and they did, but still really strong growth, really strong growth. Yeah. Now, last year was one of those times where we had good returns. A lot of it came in the fourth quarter. We had really strong fourth quarter returns. But for the Magnificent Seven stocks that we've all heard about, they really did well throughout the year. And again, it was just 7 stocks. Now, when you look at those 7 stocks alone represent 28% of the S&P 500. That's how large they've grown in the S&P. The good news is we've diversified a little bit away from that with U.S. equity factor base, really focusing in on strong fundamental companies with lower PE ratios and so forth. And that's worked okay. I mean, obviously, when those stocks are really running high, that portfolio is going to underperform. But when we start to see those sell off, that's probably going to be one of your best performing equities within the portfolio. You can see the Magnificent Seven. So look at the large cap indexes on page 5. That was the big winner. And all that can be attributed to what I just talked about. But going through these, you can see everything did really, really well throughout the year. Now, a lot of these numbers really picked up in the fourth quarter, as I mentioned. But small caps did well. We saw money moving into riskier parts of the equity parts of the markets, such as emerging markets, international, and then fixed income really picked up. Now, fixed income is interesting because if you just looked at it through the third quarter, fixed income was negative in a lot of areas because rates were going up the first 3 quarters of the year. But fourth quarter, we saw rates come down, so prices went up, and they performed very well and actually benefited the portfolio. On page 6, couple things, because I don't want to steal Mark's thunder a little bit later, because I know he has a lot to talk about, so I'll be brief. You can see the story here again with growth and value. So when you look at the 1-year returns for growth of 42%, all attributed to 7 stocks, and then value is only up 11%. So really big differential, a big turnaround from what happened in 22 when all those tech stocks sold off, and we saw more value-oriented companies do well in 22. The other thing I'd like to mention is on the upper right-hand chart here, you have 2 bars. You have large cap stocks, which is the darker one, which perform better. Then you have small caps, which are the teal bar, which underperform large caps. We do anticipate with now that we know rate hikes are pretty much over, unless some data comes out that really changes that, and rates might be cut later this year. We expect that small caps should perform better. Because when you have a higher interest rate environment, it costs a lot for these small companies to borrow money to keep their companies going. And then also the recession word, which came out last year, we're going to have a hard landing or we're going to have a soft landing. That really spooked people away from the small caps because they're impacted more by a recessionary environment. We expect the small caps to do pretty well moving forward as long as that trend continues. On page 7, so let's take a look at international. International held in there pretty well with the U.S. and underperformed the U.S. a little bit, but there are areas that actually did really well. So if you look at Latin America, that was one of the top performers. A lot of that can be attributed to the news about the Fed pausing. There's a lot of uncertainty around rates continuing to rise, a lot of uncertainty around currencies and trade. But now that that's calming down, we're starting to see, again, money flowing back into the more riskier areas of the market. Latin America is one of the biggest beneficiaries.
You see the concentration, Latin America, like 7 large cap.
There are. It's just a few countries and a few of the larger corporations driving that number. Now, the same would be the case for Asia. Asia did not perform that well. But if you excluded China from this category, it would have done a lot better. China had lost $8 trillion in their stock market last year. $8 trillion. So they're really struggling. They have issues with their housing market, banking systems. They're really looking now to stimulate their stock market and their economy. So you may have seen the last couple of days that Chinese stocks actually started to go up as a result of that. So it kind of reminds you like markets react to stimulus, how the US did way back when, how Europe did. We're seeing that now in China. And the main reason why they're still struggling, frankly, is COVID. I mean, I hate to bring that word up anymore, because it was a while ago, but it's the reason they shut down entire cities of 20, to 50 million people. That has an impact on your economy, significant impact. I mean, they're still feeling the pain from it. Japan also did pretty well. They're also one of those countries during COVID where they really just started opening up about 6-8 months ago. And you can see that they actually, their corporations, their earnings are doing really well. Consumer spending really picked up. They're one of the countries out there, it's very rare because they still have negative interest rates. You remember when we had negative interest rates across the globe? Well, they're one of the few countries that are slightly negative with their interest rates, and they have very low inflation. So it's much different than the rest of the globe. So they've been performing pretty well also. Any questions around that? Okay, and on page 8, we have fixed income. So there's a lot to talk about here. I won't spend a lot of time about it. You can see the yield curve here and what it's done over time. So 12/31/2022 is the top bar, the black bar. Rates were really high at that point in time. But you can see as we moved into 12/31/2023, a lot of that happened in the fourth quarter, by the way, which I mentioned. You can see rates came down across the yield curve, and that's where we saw the positive performance in your fixed as a result of that. We are in the camp that a lot of economists were in the camp that we would have 2 rate cuts or possibly more in the first half of this year. Well, Powell came out last week and basically dismissed that. So that's off the table. SEI is in the camp that we'll probably have maybe 1 or 2 rate cuts later in the year. So we still think we're well positioned in our portfolio. We shortened duration a little bit. We think we're well positioned going into that environment. We'll talk about the numbers on page 13. So it was a really good year last year. On a net basis, you were up 15.53% calendar year. We had a really strong year. As you remember, it was 2022 was a pretty tough year. So we gained a lot of that back, almost all that back. And a lot of that can be attributed really to the large cap strategies, as well as some of the fixed income strategies. So moving ahead to page 14, you can see for fixed income was up 6.6%, limited duration up 5.5%, but then your more riskier fixed income asset classes, high yield, emerging markets debt, were up 14 and 15%. So really strong returns there, and a nice bounce back in the real estate fund. Keep in mind, this isn't like a core real estate fund where we're actually buying buildings, you're investing in buildings or new projects. This is more of a REIT type fund, so it's more of a leisure, hotels, things like that. So that really bounced back, as you'd expect, because all the markets are open, they're running, people are going out, they're traveling, and taking advantage of having their freedom again that we lost for a while there. Any questions around that? And you can see on page 15, if you look at the calendar year, so essentially we almost got all that back from what we lost in 2022 and 2000. After this meeting, Mark and I, before the next meeting, are going to get together and look at your asset allocation, just to make sure everything's okay. So we're going to work on that together as well. But that's all I have for now.
Come back next year.
Yeah.
Try.
Now, why does the, like they're saying yesterday down, why is like the agriculture, there's more yield of product out there?
Agricultural commodities prices are down. Well, that's a whole inflationary story, right? So it's interesting you brought that up, because usually when I go to the supermarket, my bill was over $300 every time. Now I'm going there, it's like $225. So you can see inflation has come. So a lot of that is supply chains are improving. Agricultural got hit pretty hard too, because we had all the wildfires out west. So there's a lot of components that really fed into that. Right now they're getting pretty wet out there. So as you can see all the flooding in Southern California. So those are kind of the 2 main components: supply chains and then all the wildfires last year, as well as prices just compressing.
Thank you. Appreciate it. Mark?
All right, good. So I'm going to make a few comments on the economy as well. I think our view at SageView is pretty similar to what Pat just went through, but I'll touch upon some of the high points. And then again, our role is to do the investment monitoring, to take a look at the funds that SEI is using in the portfolio to make sure that they're competitive and meet our criteria. So I'll walk through the monitoring as well. All things actually are firing on all cylinders and look pretty good. So I'll hit a couple of high points. If you go to page 44, it's page 3 of our deck, but page 44. of the combined deck. And this just gives our outlook. So Sageview's got a 30-person investment committee. Again, I think a lot of our views are pretty similar. We do think growth will slow in 2024. Last year, we were pleasantly surprised, but with
Mark, interrupted, but can you tell us what page in the actual report it is?
I think page 40.
yeah, it's page 3 in our report,
Page 44.
and then 44 in the report that was sent out. That was combined with all the decks.
Thank you very much.
Oh,
Thank you, sorry about that, go ahead.
Yep, no worries. I know it gets confusing when they get merged. So we are predicting slower growth in 2024. Recession is still a risk anytime the Fed has interest rates at a higher level. You run the risk of a recession, although it looks like a soft landing where the Fed, kind of starts to ease on the brakes in time not to stifle growth is a real possibility. We are bullish as a firm for equities, meaning we think stocks will rise in 2024, but we predict more single-digit type of returns. There's a lot of geopolitical headwinds. Prices are pretty expensive, especially in the U.S., and we think economic activity will slow. The market, as Pat said, the market is pricing in 6 rate cuts. We think that's very aggressive. The Fed is signaling 3 rate cuts. I think that's probably a more realistic number unless we start to see recessionary data and the Fed has to act a little bit quicker. But we kind of err on the side of probably less cuts in the second half of this year. If you go to page 5 of my deck, 46 of the merge deck, a lot of the high points that we hit, the NASDAQ, which again is made up of more of those larger growth technology companies and those AI stocks that Pat talked about, up 45%. S&P 500 up 26%. Strong international returns and also a little bit more broad-based, so more participants. We also are hopeful that this is a broader rally into 2024 with maybe less participation from some of those dominant stocks and a little bit more participation from some of the other components of the industry. We also think that with rate cuts, the dollar's strength should decline, and that should be beneficial for international investments. So a couple of things as Pat and I kind of prepped for the meeting. We talked about as for our next meeting, when we know a little bit more from the Fed, is we'll take a look at the duration of the fixed income portfolio. Right now, we're sitting on a shorter duration, which has worked out well. We're getting a better return with lower volatility and risk. But as rates start to come down, there'll be more opportunities for a longer duration. And then we'll also take a look at the U.S. versus international component and perhaps suggest some slight changes there. Page 6 or 47. This is just our outlook or our scoreboard, and nothing's changed since the last time when I was with you a few months ago. We're still confident in the employment market, showing no signs of real slowdown. Wages have been good, and when that happens, people spend money. And in the U.S., we're dependent on consumer spending for about 2/3 of our growth. We think that will continue, but at a lower rate into 2024. Haven't gotten much help from manufacturing, global trade, fiscal spending. And we've got the election this year, so we don't expect too much more fiscal spending. The neutral remains the uncertainties. Will inflation continue to tick down? When and how much will the Fed cut rates? That will have a direct effect on corporate earnings and the housing market, obviously, with mortgage rates. I won't bore you with page 7. I think Pat's slide was very good. We show you 3 time periods on the left-hand side, and then break up the global stock market on the left. The right-hand side just breaks down the components of the S&P 500 in the U.S. but I don't think there's any major points we need to point out there. And then page 8 or 49, very similar to Pat's deck with the yield curve. That's really where all eyes are on. And, you can tell generally day by day when you look at the market, it's kind of been dominated by what longer term yields have done, affecting both stocks and bonds. So we've got that really high end of the short term of the curve. We expect that to be cut, anywhere between 50 and potentially, I guess, 150 on the aggressive end and the front end. So we think by the end of the year, that short end or the left-hand side of the page, yield should come down quite a bit. We also expect longer-term yields to come down a little bit from where they are today. And that should give us some opportunities from a fixed income perspective, especially maybe going a little bit longer on the weighted duration of the portfolio. All right, I'm going to flip ahead a few slides to page 15, 56 of the combined deck. And again, SageView acts as a registered investment advisor. We apply a quantitative scoring to the funds used by SEI. We look at 9 factors, and those include performance, risk-adjusted performance, consistency, up and down capture, how well a fund does in a year like last year when the markets were strong. More importantly, how did they hold up in a poor year like 2022? And then we factor in expenses to give each fund a score. And the funds in your plan on average score in the 21st percentile. That means they beat generally about 80% of their peer group. So that's very good, top quartile. And we apply this for the actively managed funds in the plan. And you can see the detail on page 16. So those are the 6 actively managed funds we use. And you can see left to right are the 9 criteria that we compare each fund to their competition or peer group to. And the far right is the overall SageView ranking. Again, lower is better as you look at this chart. So for instance, the SEI limited duration bond, when you look at those 9 criteria, 7 of them are above average. Very good. A couple of them are kind of middle of the road. The up capture ratio is in the 57th percentile. That judges how well does this fund do versus its peers in up months where bonds are positive. More importantly, for our scoring, how do they hold up in a down market? They tend to beat most funds in a down market. So those 9 rankings translate to that top quartile or 23rd percentile score. Okay, our goal is to have everything top or second quartile, so 50 or below. And as you can see, most are top quartile. The emerging market debt is a little bit of an interesting one. This is a smaller category, so the score is going to fluctuate. If you remember, just I think 1 or 2 quarters ago, we were in the 3rd quartile, seeing some strong performance versus its peer group, and the score has improved into the 41st percentile. This fund's been good since added. I think SEI added it back in 2022 when it's added some benefit to the portfolio. So nothing on our watch list there. The next page looks at the index funds we use. A little bit more simplistic scoring. It's mostly around expenses and tracking error. And you can see all the funds are generally top quartile, 1 fund in the 26th percentile. Page 18 just includes the historical scores. And page 19 just confirms that we don't have any funds on our watch list. And it's really been a while since we've had replacements and funds on watch. But if a fund scores in the 3rd quartile or has a major change, maybe in the personnel of the fund, we'll put it on the watch list. Generally, after 4 quarters, if the fund hasn't improved, we would then look at replacement options. But at the moment, as of year end, we don't have any funds on our watch list. And that's all I had for prepared comments. Kind of a quick quarter this quarter.
Okay, thank you, Art, appreciate it.
Welcome.
Moving on to the actuarial evaluation. You want to come on up here?
Yeah. Everybody's got the hand up. Yeah. Forward. Always like to kind of go over what we'll talk about. Go to the next slide. What's the main reason we do the valuation each year? Go over the liability results. Here's assets. Based on the assumption change. We do each year we do a public survey where we call the years are 4. First, the purpose of the valuation. We'd like to bring this up because we all meet every year. We don't meet once a year. We'd like to make sure we all know next time, what the reason is, why we do evaluation. That's to there's a determine the ultimate cost of the plan. Benefits promised to your employee. We want to some kind of way to help the town manage that. What is that cost going to be? You promise benefits, you have payouts and benefits, there's expenses that come in, whether it's actuarial, legal, auditing, you have those as well. And that's going to be offset by employee contributions. And the biggest one that I always like to focus on is investment. The better investments do, the less the town's got to put. We come up with that. So then we do the valuation. So we come up with some kind of cost that allocate each year a portion of that cost that you're going to pay out over life. So for each budget year, so you have to evaluate, you do a budget each year. So we want to come up with that cost. That's kind of what with evaluation, kind of a tool to help us. So inside that report, we come up with an actual determined employer contribution. And that's the main number that really you guys all focus on, right? That's really the cash amount you have to put in. That's made up of 2 components. Total cost, which is benefits earned each year. That's for all your employees that are currently working. They're earning benefits. So you want to pay that benefit that year. The other piece is amortization of past service. So if the town hasn't always been making the contribution for the loss over the years, there's some sort of unfunded liability people are getting through. You kind of have to amortize that. You have to pay for it. You're not going to do it all at once, so you have to amortize it. Mortgage. And if you remember about 4 or 5 years ago, we're doing layered amortization. We do that to kind of with that intergenerational inequity. The people that earn the benefits of that, read that chunk of unfunded liability each year, we want to allocate it to that for that group of people that they go through the workforce. So you're paying over their 20 years of work, a little slice of that piece that was incurred like that. So it's kind of want to do that. Okay. Next slide is going to just touch on the key results. So on the market value of assets, the assets did pretty well. You're in almost 10%, 9.8%. You assume 7%. Remember, the 7% is really matched up against the actual value of assets, the smooth asset. So that's only 5.6. Part of that is because you remember last year there's huge losses. We kind of smoothed. One thing I do like to always point out is when I talk about the return of assets on a fiscal year basis, so that's July, June. Typically, when Pete does this, he's on a calendar basis, and you get more up to date. That's 630.3. Next, assumptions. So what happened? We didn't change the mortality assumption. A couple years ago, remember I said we're going to do that every year. But then what happened? COVID happened. They're still kind of quantifying the impact of that. What does that really mean? Because there was a lot of data, some not everybody's reported mortality. That's properly, geographically, things like that. So they really haven't updated that table yet. They expect to do it this year. Other key assumption is inflation. I kind of look at the Social Security Trustees report. For the last 3 years, they kept that rate at 2.4%. So inflation is pretty high in the last couple of years. But remember, pension plan is a long-term term, right? It's over the plan. That trustee report kind of looks at things over 7 years. That's what they have. And if, remember, if you hear in the news that the Fed's really goal is to have inflation around 2%. So 2.4 is not really. One assumption that did occur, that we did change this year, long-term investment return assumption, which equates to discount rate for liabilities. We dropped that from 7% down to 6.75%. That's really to more align based on allocation of your assets as well as the capital markets. But that right now, I think it's coming up with a rate about 6.5, 6.75, moving in the right direction. Now,
Just to mention, we'll have to take action on that formula. We had to give them a number though. Budget.
So when we move that down, the budget.
But we want accurate.
yeah, whatever, all those things kind of look at when you guys go out. All the assumptions you are using for liability. Be a little more concerned, so you're right there. I always think 6.25, 6.75 is probably the sweet spot for most plans. Not everybody's there. You later on, around 6.5. You're moving in the right direction. You're not too long, about 6 or 7 years, you're at 7. So last 6 years, you got to move when you could. You think opportunities to move good. And it really is. We'll see it as execute. The budget, as it is, as I point out, is just over a little more over half. That is a bigger number, but it's just something that's all part of everything, the bigger picture. On the plus side, there were liability gains. Salary, not as high, retirement experience, mortality experience. That was about 1.8% of liability. This kind of offset the losses on the asset side. Remember, the asset losses are the actual. That's about. Overall, what happened? Your 8x about 6.5 million based on the lower discount rate. Actual determined employer contributions. So that's the cash contribution that you're putting in your budget for the year. That's what. That's the line.
By moving, we're going up about, let's put in another 6.
Yeah, it was just about 5.9 last year for its current budget. That's what item there's. Remember that we have 6.5 million of unrecognized losses on the asset side. What that means is going to put upward pressure on your contribution. I put down 150 a year, roughly over the next 4 years as that's again, it's that number moves year to year based on what piece gets amortized that or comes off, and you recognize that year. Every year is different later on, and as well as it offset of losses.
That's smoothing.
Yes, and I got a couple of slides later, so you can kind of see more. Yeah, smoothing. Next, any questions so far?
Yes.
So the other next few pages are liability. So this is the liabilities that you have, right? And last year to this year. So the liabilities on the inactive side went about 3 million up to 117 million. Your active liability again went up 3 million, 62, almost 63 million. And that's what you're comparing against the assets, the actual value of assets, 4 million to 144. So that difference in the liability assets is the unfunded liability. That's what you amortize. That other component makes up that ADAC contribution. And if you look at this, what you see is last year about 79.6% funded. This year it only dropped a little bit, 78.7. So you lost about 0.9% of the funded ratio, and you actually moved a more conservative to a better, more accurate discount rate. That's not really that cheap. I look at it as kind of opposite. It didn't change much. Your target may be 80, probably 85, obviously 100, but you didn't really do much damage by dropping the discount. I look at that as a positive. You may not. There's still a higher contribution required. As always try to look at the sunny side. Yes.
I'm sure. Where is it at?
And which town do you want to ask about? Some are, in the 80 to 90%, 50%. So it's, and some of those ones that tend to be lower tend to have a more favorable discount rate, which doesn't help. I look at the water barrier, they have a much higher rate, they're still not funded. The towns tend to be a little smaller, tend to be able to manage the budgeting, I think, a little better in the bigger cities. They have, the tax base may be better for small towns. I just know what I see, the stats. Like, 80, just under 80 is not bad. We'll see that in the back when I get done, compared to other, all the other towns. The next slide is the second component part of the law. This is the first one. I don't think. This is the unfunded liability, as I mentioned. You do slices of it, right? Kind of do layered amortization, right? But when we first set it back, the liability, unfunded liability was at almost 28 million. That's what we're, so we're already down 16 to 16 years left back now. Technically fully amortized. All the other slices, which ideally should be much smaller. And although these are all negative, I do have some, you see sometimes where it flips, where you have a gain 1 year, and so you have a credit that, for those. So it's just kind of showing you what that is. Eventually that'll have 20 lines. Next is, we'll just touch base quickly on the assets. Yeah, remember, we're doing a fiscal year basis, so show the market value and the actual value. I'll point out market value, what you do use that for is in your financial statements. So when we do the gathering disclosure at 6:30, they actually use the market value. The smooth is good for coming up with a contribution schedule, whereas they like to take a snapshot of liabilities to actual assets as of 6:30 each year, each fiscal year. That does get you that. And what you can see, so we have the contributions come in, 6.6 million come in, but the next number, you're paying out over 11 million, right? So right there, that's kind of a negative cash flow. So that difference for your asset to grow needs to be made up by the investment. Market value, you got 12.5 versus 7.7. That's horrible, almost 10%. Obviously, we want the actual to go a little higher, closer to that. To the 6.5 ideally, right? So you don't have losses. But that difference in those numbers is the unrecognized gain, unrecognized losses that happen. Right? That's why the actual value is high. You have unrecognized gains, market value is higher.
Describe the difference again, the actual variance.
Actual value is a smooth value. So on the next slide is where we kind of develop that. So that's a smooth value. We smooth it over 5 years. Right? That's really to dampen the volatility of swings in the market, which we've really seen the last 3 years, versus, so if we have those high swings up or down, that means when you're doing your budgeting, up or down if you're budgeting on market basis.
Sometimes the actuarial value is lower than the market.
If you have unrecognized losses. The actual value is higher if you have unrecognized losses. So if you look on this slide, you see that bottom box shows the 5 years, right? You have that 91 million. That was a pretty a neutral year. Then you had $2 million loss. Then you had that, everybody was happy that 2021 you get a big huge gain of 25% returns. Then the next year, totally flip-flopped, and we had that huge loss of 30 million, right? Which is more devastating, even though it may have been like a 15% versus. But you started with a much higher number now, bigger loss. That's really the driving force of what we're smoothing. And then this past year you have 3.6 gains. We want more of those gain years, right? Or at least somewhat neutral, and it's not, you don't have to bring it down. There you can see in that column E is that 65 minutes. That's the difference between actual value. If these are gains that you have, that would drive the actual value below the market.
Most of the actual returns are the 6. Less than delta.
Yeah,
Over time.
Yeah, over time. Next picture is just a graphical. So you can kind of see, from 17 to 20, market and actual kind of, in that 10 to 5 to 10 range. Then, 21, 22, 23, and you have those big swings. But you can see the red is the actual value. and it's kind of stayed more stable. You know, so it's easier. You don't have big swings in the contribution, which could be. Oh, I got to put another 1.5 million in. Next slide just again kind of shows the funding, how the funding is going. 17, it's probably right when we were at 7.25, I think, if I'm not mistaken. Usually 7.5, 7.25, and then we dropped it down to 7s back in 2019 or 20, I think 20. So you know, it's still pretty good. And then this year, dropping it down to 6.75, not much movement. But what you can see there, all but that huge year that the assets did pretty well, the actual value on an actual value basis, your funding level, funding ratio is a little higher than our market. And so, any other questions? Giving you a lot of information.
I have one question. You said, SEI follows the calendar year, you don't.
Because you fiscal year, we follow your fiscal year. You do your work on. That's kind of a government requirement. You have some pension plans that do a 1-1 valuation. But you have to adjust that. Which have more on.
Should we can include a fiscal year to date column in your performance report. We can do that for matching.
I always just bring it up because the 1 year when we're both together, we say, most of the time they're talking calendar year, we're talking fiscal year, and like,
There's a big difference.
in December really bumped up your asset rate, kind of thing, so he's all happy. Could have been last year, you may not have been so happy, you know, so I always just like to make sure that you're aware of it, so it's not distorted, you remember. We're actually, when they go first, they're ahead of time, they're more closer to the future, we're a little bit back. But we're really budgeting for next year. So, you know, it always follows.
Slope this be. Lives, hybrid.
Well, what's really, I mean, a couple of things. You remember, you've gone down at least 50 basis points from or something, or active. So yes, it's gone down from 85 to just under 80. But once you level off, you're at the right spot. You won't be moving your investment return assumption.
But the impact of that, if we're
Yes, remember though, that they are looking at your assumptions that you were, if it was like that and you were using 7.5, that would probably be a red flag, right? That you talking like really lost it. Not get a feel. Maybe you said no, if you're using 6% and it was like that, that'd probably give you a little. Back in the day, we were told that they would always just look at funding ratio. And then, when all the towns start, having trouble budgeting and things, Gabby stepped in and kind of said, okay, you got to really more realistic assumption. No more using the 8% measure liability. That's really overstated. Hard to state. Now things are more closely monitored, whether it's the best return assumption, how is a big one, there are other assumptions, value scale. They look at all that now. But again, bottom line, they're going to look at your funded ratio. So now we'll get more of the back behind the scenes stuff. This is the actual experience, right? So go from top kind of block of set of numbers, just going looking at that unfunded liability, how that changed from last year to this year is what we expect, right? So it was 36 million. We expected to be 35.5 million. Or any changes, it was 34.3. So that gives you an overall gain, which is actually pretty good based on all the things that you've done. So that gain kind of. Yes, yeah. So it's not those when you do those good, get those big returns. It's not a bad time throwing some changes or some of the sources, so you have, on an actual basis, almost 2 million of losses. The salary increases 1.7 million. That could be because a lot of people get tired, so higher salary people leave, replaced by much lower salary people. If you had quite a large turnover, we'll see. Assuming that's I expect. Gains on mortality, turnover, so those are kind of your decrements. New entrants, 20,000 up in change in benefit rate. So we expected, maybe $1 million more than we actually paid out. That's happening. Changes increases at 4.5. Slight plan provisions, one of the groups. Formulas was updated. Service 130. Yeah, so extended. Actually, for the division. Or we didn't use the provide. Yeah, so their multiplier, say, might have been 1.5, but should in the evaluation report, but it's something like that. Small group. Next page is development of the contribution, 8X. See kind of the normal cost, the net normal cost went from 2.2 million. So that went up a little bit, as far as that's the new entrants. And we do, to point out, we do expect that normal cost to go up each year based on salary scale. But it's just additional because your pay goes up, whatever that is. So their benefit for the next year is going to be kind of high. That's kind of way worse. The unfunded liability went up a little bit. With the interest adjustment from 5.9. Next page kind of shows you how we went from, this is again before interest adjustment to 5.6. Current assets increase the contribution. Liability gains decrease. Big one is discount rate change. Really small impact. New entrants, so that's all the new entrants, right? We're not counting for them before. Whatever that is. This one, perhaps probably not trending in the right direction for you, right? It almost doubled in the last 7 years, over 3 million, a little over 6. The blue bar kind of on the bottom is the normal cost, right? You kind of expect that to go up, and it'll go up a little faster as more and the population. So it went 305 to expect. The more concerning is the red, right? Because that's the unfunded liability. Well, we're going straight down. Really, investment return will help straight. Part of that obviously is going to do 2 or 3 rate adjustments. We don't talk too much about these. The next 3 are more for kind of internally. So this is all the liabilities and all the key components for the town group. The next page has the board event group. The third one has the fire and obviously the total. Questions on it. But maybe what that does tell you, you guys have got a lot of unions, you got to cost. Next page, kind of some change in the participant data. Right? Really, look at the last column, 742 to 754. So that means you have 12 more more people. So just by that, you expect possible. Part of that's the act. Right? That mentioned here, you see at 43. That's probably the most likely the cause of salary in the social salary. Hire people who retire, so you make retired. And retired, you have a bunch of lump sum. Correct. So my retired. This page is like one of the first or second page in the valuation report. Pick that report up for, like some might be the main page to focus on. It really has all the key components. Got the data up top. Next block shows the salary. Third shows the liabilities. Fourth is assets. Fourth is assets, unfunded liability, the funded ratio. Very bottom. Data. Most of you have this. Looking ahead, and at 6.75%, what do we think? We know the unrecognized gain losses in the recognized 1.8. That's going to drive the recognized gains, losses, upward pressure. When they're all, if you earn no gains or losses each year, within 4 years,
Oh, there's no loss.
yeah. So
The mechanism, so is there are cost of living adjustments?
actually,
Is it corrected linear?
that's really just focused on the asset value. Or the actual. What's break it down, it's closer together, so.
I'm asking it really basic. So as people, as I'm an employee, my wages go up.
Yeah.
By 5%. My contribution goes up by 5%.
Employee contribution?
Yes.
Yes. Employee
So,
contribution. That's tied, yes.
There's no.
Whatever,
salary
yeah,
or
they're
anything.
paying, whether it's 5% or 7%, 10% of their pay. They go 45,000, 50,000, that additional 5,000. That's in the year. Again, remember, there were budgeting. So in your example, if they were 5%, that would create a loss. If we're our salary scales, 3%. That's 5. This is pretty aggressive. What else? Contribution between the Board of Ed and town, a little disproportionate to the Board of Ed. If you just look at it, they're over 5%. At 70. Changes. Board of Ed. That's the 25 basis point change in discount rate. You went to 6.5. West, you just did that one. So this is what we do. We do an annual analysis of all the Catford, all the towns that are in there. Remember, this is also lagging, so this is all the Catford that orbit for 6/30/22. Right now, yeah, we probably they're not all done before it was 6/30. So it's a little behind, but it does kind of show you where you are. What this shows in the investment rate of return, the average is about 6.5. So you're a little higher than that, but you're in a good spot. 6.5, 7%, 45. Next one is more to what you had been asking earlier, funded liability, right? So you're just under 80%. So that would be that 24% in the middle. One thing you can tell from this at 6/30/22 was that everybody shifted down. They shift up a little bit, I think it's been a mixed bag. Where certainly the evaluations I've done this past year, they didn't move because remember, assets at 6/30. Assets were not that great at that point in time, as at 12/31. Now, just kind of so you can kind of see what the first year, if you wanted to know specific count of that. Questions there.
Thank you.
Hopefully, I try to make the complex a little simpler for you. While back. Sense I go with that a couple slides that show you the GASB, which is the account financial numbers. It's put in your paper. Those may not.
We're gonna need once you're ready, a couple different motions. One of the motions to accept and file, but also a motion to change the return assumptions. 6% down. So one combined motion for both.
Oh,
Do you want to start with the
whatever way.
sort of tied in?
Yeah.
Probably
you're gonna
doing
keep
both. One large motion.
Excellent.
All in favor, say aye. Aye. Carries. Led you to the 6.5%.
Yeah, so I think what did we do last time was 20,
Clear,
2 to 3
maybe.
years.
How do we?
Let's see how it's on.
Yeah,
Decided to do.
Well, we have to have this report done each year, and then, because it has to be, we have to get the parameters earlier, a while ago. It was just good timing, when to do it. You gotta think about, we do.
You guys.
Yeah, and we also look at what's the budget, it's gonna be, it could be 600,000. Well, what's the impact of that gonna be?
And remember, the driver is based on your asset allocation, your capital market. And so we give them.
Oh, you mean all these pieces?
Idea, surprisingly, they do, yes, so a lot of times we work with. Early history. Asset allocation, so, that can change. Based on that, in the valuation part, we do show that development, what we expect the return is. So you're still a little high. Last year, it was 7.675, and you're at 7. Which is, so they definitely have more conservative assumptions because some of them I've seen. But all those towns. Get this return all of a sudden, we're not getting up. So, that.
These are from, excuse me, July 2024 budget. These numbers are.
Yes, 25. Yeah, 24 for the 25 budget.
Like, it gives them time.
Yeah.
To-
Deliveries.
No, I mean, it's not here at this point, it just shows up. No,
So you guys in the final approval.
it shows up in the town manager budget.
Now,
Most people seem to understand nowadays, you want to talk about it.
Right, that's a town thing.
We've never
Some
had
are
much
harder.
issue with this. Well, if anything, people kind of have a OPEB contribution, but on this one, people, the other post-employment benefits. Because traditionally, that was kind of later to people paying attention to. Same kind of process.
The big question is, are you want that one?
Yeah, we're, wait, 40-ish,
Oh, 40, it's not bad.
40, somewhere in that range. Oh, 48 is a little more, that's actually pretty good for towns.
We're starting to creep up there, so then the next question. When do we start paying?
But it has been something historically, at times, town councils more apt to, more likely to. Because I do hear some other towns pay as you go, or, well, why we put it. But yeah, never had any questions since I've been around.
The gas.
Gatsby as well, yes. That's still, you're putting those in your financials as well, that's part of it. We don't do that plan. It's, to its point, 50% of the town is roughly. So. Build the trust so that investments get started. Right, it's usually the first one to get cut because most people are late.
Husband used to say they'll fight over 12,000, but they won't question 600,000.
We say that all the time. Okay, thank you.
Thank you.
Any other business? Yeah, I forgot. I would entertain a motion to adjourn. Who's that?
I
And adjourned and, oh, yeah.